Today, we are diving deep into a really big topic, India's complex economic scorecard. We're going to break down something called the twin deficits and explain why managing them is this constant, high-stakes balancing act for the country.
Okay, so let's start with a question that kind of puts it all in perspective. We all manage our own budgets, right? Money in, money out. But how does an entire nation with over 1 billion people do that on a global scale? How does it possibly keep track of every single dollar, yen, and euro coming in and going out? So here's how we're going to tackle it. We'll start with the big picture, the nation's global scorecard. Then we'll get into the nitty-gritty of its income and expenses, figure out how it covers any shortfalls, and then we'll diagnose the core issue, the dual deficit problem. After that, we'll see why it actually matters to you. And finally, look at India's incredible economic balancing act. Right, first things first, before we get into the weeds, we need to understand the main tool that economists and policymakers use to get a snapshot of how a country is doing financially with the rest of the world. And that tool is called the Balance of Payments, or BOP for short. Honestly, the best way to think about it is as India's ultimate financial report card. It meticulously records every single economic transaction, from the tea we export to the smartphones we import, and every single foreign investment that comes into the country. It's the whole shebang, the big picture of our global financial health. Now, this BOP has two main parts. The first one is called the current account, which you can basically think of as the country's day-to-day income and expense statement with the world. Now, what's really fascinating is how this shows the two different sides of India's trade story. When it comes to physical goods, things like crude oil, gold, electronics, we typically have a deficit. That just means we buy a lot more than we sell to the world. But flip over to the services side, and it's a completely different story. Thanks to our absolute powerhouse IT and software sectors, we run a really healthy surplus, exporting way more than we import. So here's the bottom line. When you add it all up, that massive bill for imported goods, especially oil, almost always outweighs what we earn from our services. The result, something called a current account deficit, or CAD. But there's a major lifeline that helps plug this gap, and that's remittances, the money sent home by millions of Indians working overseas. This is a huge deal. That inflow of cash is so massive that it often covers more than half of our entire goods trade deficit. It's an absolutely vital cushion for the economy.
Okay, so if the country is spending more than it's earning on that current account, how in the world does it make up the difference? Well, that brings us to the second major part of the balance of payments.
And this is the capital account. So if the current account tracks day-to-day income and expenses, the capital account tracks the big money moves, investments and loans. It's the part of the ledger that shows exactly how India attracts foreign cash to finance its deficit and, well, balance the books. Now, this breaks down the two main flavors of foreign investment. On one side, you've got foreign direct investment, or FDI. Think of this as long-term, stable, sticky money. It's used to build actual things, like factories and infrastructure. On the other side, you have foreign portfolio investment, or FPI. This is money flowing into stocks and bonds. It's much more short-term, and crucially, it can be pulled out of the country very quickly, which makes it a lot more volatile.
All right, now that we've got the building blocks, the current account and the capital account, we can finally put it all together and diagnose the central issue we're here to understand today.
So, problem number one is the one we've already been talking about, the current account deficit. Simply put, as a nation, India is spending more foreign money on stuff from abroad than it's earning from its exports. And problem number two is an internal one, the fiscal deficit. This means the Indian government itself is spending more money on things like subsidies, infrastructure, and salaries than it's collecting through taxes and other income. So it has to borrow money to cover that gap. And when you put these two problems together, you get the dual deficit problem. It's kind of like a double whammy. The country as a whole is spending more than it earns from the world, and the government is spending more than it earns at home. This combination creates a really unique set of economic pressures. So I know, these are big, abstract economic terms. Fiscal deficit, current account. But why should you actually care? Well, because this dual deficit has very real consequences that can absolutely affect your daily life. Let's just follow the chain reaction here. A high dual deficit means there's a huge demand for foreign currency, like the US dollar, to pay for all our imports and debt. Simple supply and demand. This puts a lot of pressure on the Indian rupee, causing its value to fall. And when the rupee is weaker, everything we import, from the petrol in our cars to the parts in our phones, costs more. And that, my friends, leads directly to higher inflation. All of a sudden, that imported cooking oil in your kitchen costs more, and the price of that new phone you've been eyeing just went up. That is the deficit hitting your wallet. Directly. And the impact doesn't stop there. A persistent dual deficit makes our whole economy more vulnerable to global shocks. If interest rates suddenly go up in the US, for example, all that volatile FPI money can leave India in a flash. It also puts the country's credit rating at risk, which can make it more expensive for both the government and for Indian companies to borrow money down the road. So, given all these risks, what's being done? This brings us to the really complex policy challenge. See, managing the dual deficit isn't about getting it to zero. It's about keeping it at a safe, sustainable level. It's a true balancing act.
And this really summarizes that balancing act perfectly. To tackle the huge import bill, you have initiatives like Make in India and special incentive schemes to boost manufacturing right here at home. To keep exports strong, there's continued support for our champion sectors like IT and pharma. To control government spending, the focus is on reforming subsidies to make sure they're targeted better. And to handle that market volatility, the Reserve Bank of India is constantly working to build up a massive cushion of foreign exchange reserves.
So, look, if there's one key thing to take away from all this, it's that managing the dual deficit isn't a one-time fix. It's a constant, dynamic process. It's about adjusting policies all the time to respond to what's happening both at home and around the world. Getting this balancing act right is absolutely essential for India's economic stability and its strength against future shocks. Which, of course, leaves us with one final very important question. In a global economy that is always changing, with geopolitical tensions rising and trade patterns shifting, can this incredibly intricate balancing act continue to hold steady and steer India towards a stable economic future? That, right there, is the billion-person question.